Welcome to our quick introduction to cost segregation. Tax deferral strategies are a great way to minimize taxes, and cost segregation and Internal Revenue Code Section 1031 exchanges are two of the most valuable tax deferral strategies available to commercial real estate owners and investors today. Section 1031 exchanges have long been a favorite tax deferral tool. In these exchanges, your commercial real estate is sold by a qualified intermediary, and they use the proceeds to pay for a replacement property of like kind. By handling your property swap in this manner, the IRS allows you to defer all or most of the gain that would have been subject to income tax on the sold property. Recent guidance from the IRS and some of the most tax-friendly legislation since the Tax Act of 1986 has also made a second form of income tax deferral increasingly popular. It's called cost segregation, and the goal here is to identify components of your commercial building that can be reclassified from real property to land improvements and tangible personal property. And the purpose of all this segregating and reclassifying? Simple: to put more cash in your jeans each month. Here's a quick explanation. Reclassification of building components from real property to land improvements and personal property results in a substantially shorter depreciable tax life and the ability to apply accelerated depreciation methods. Now, ordinarily, the cost of real property is recovered over lengthy time periods using straight-line methods of depreciation, specifically 27.5 years for residential property and 39 years for non-residential property. However, personal property is recoverable over considerably shorter periods, for example 5, 7, or 15 years, and uses accelerated or front-end loaded methods of depreciation such as 200% or 150% declining balance. When real property is reallocated to personal property, the differences can be huge. For example, installed carpet purchased with your commercial building is considered personal property for depreciation purposes and recovered in a 5 or 7 year period using the 200% declining balance method of depreciation. Otherwise, that same carpet would have to be capitalized and recovered on a straight line basis over 39 years. The result is an increase in your current year depreciation expenses that should significantly decrease your income tax liability. Bottom line, more money in your pocket now. Plus, you'll save money in several other ways. One, with cost segregation, you may qualify for a reduction in your annual real estate taxes and lower transfer taxes when selling. Two, your property insurance should be less expensive. Sidewalks and parking lots don't burn, so why pay for fire insurance on them? And three, if you need to replace a costly building component, you can write off its remaining value. For example, take a roof with an initial value of $50,000. The adjusted cost basis 2 years later might be $48,000. Because you've implemented cost segregation, you can write off the $48,000 remaining value. Without cost seg, you couldn't deduct a penny. Zero, zilch, nada. The legislation and procedures used in an engineering-based cost segregation study have been around since the enactment of the investment tax credit, most commonly called ITC, in 1962. However, with the repeal of the ITC and the enactment of rules limiting passive losses in 1986, most companies assumed that engineering-based cost segregation provided no further benefit under the new tax law. But in a 1997 tax court case, Hospital Corporation of America successfully defended their use of engineering-based cost studies to differentiate between real and personal property. An interesting anecdote regarding this case: Hospital Corporation of America was aware that Walgreens drugstores had already won a similar case in district court. So when Hospital Corporation of America went to court, their chief counsel asked the IRS representative, "Why is it that commercial property owners in America do not accelerate depreciation based upon their personal property versus the structural part?" And the answer given by the IRS representative was, "Well, the service knows that they should, but we're not going to tell them." With that flippant answer, the judge ruled in favor of Hospital Corporation of America. Backed into a corner, the IRS has since acknowledged the viability of engineered-based cost segregation as a legitimate method to differentiate real and personal property under current tax law, and in fact has published specific guidelines. A properly prepared engineering-based cost segregation study will provide your CPA or tax professional with the information and supporting documentation needed to depreciate your assets over the appropriate shorter tax lives. However, it takes specialized engineering expertise to properly analyze construction information, calculate industry standard estimates, as well as identify and segregate the subcomponent costs needed for cost segregation. In Chapter 4 of the IRS Cost Segregation Audit Techniques Guide, the first element of a quality cost segregation study is, I quote, preparation by an individual with expertise and experience, end quote. The Audit Technique Guide goes on to say, quote, preparation of cost segregation studies requires knowledge of both the construction process and the tax law involving property classifications for depreciation purposes. In general, a study by a construction engineer is more reliable than one conducted by someone with no engineering or construction background. Experience in cost estimating and allocation, as well as the knowledge of the applicable law, are other important criteria, end quote. Cost segregation studies prepared by different companies vary greatly in their detail and scope. Selecting a firm that uses qualified professionals with years of significant experience can be an important differentiator in the quality of your cost segregation study. And recently, there's been an influx of vendors doing cost segregation studies that aren't even engineering based. These companies do residual studies, identifying short-term assets and lumping everything else into the long-term category. These firms charge less, but they may also overstate the short-term assets. Therefore, their studies may or may not stand up to IRS scrutiny. This leaves the property owner vulnerable to audits and additional tax payments and possible penalties. Who qualifies for cost segregation? If you can answer yes to 4 questions, then you qualify. Number 1, can you benefit from accelerating tax depreciation on your commercial real estate holdings? If you're not paying taxes now, then cost segregation won't be of any benefit. Number 2, have you purchased, constructed, or renovated, including tenant improvements, a commercial building anytime after December 31st, 1986? Number 3, is the cost of your property at least $500,000? Or in the case of a leasehold improvement project, was your cost at least $300,000? Number 4, do you expect to retain your commercial property for at least the next 3 or 4 years? Any type of commercial property placed in service after 1986 will qualify for a cost segregation study, and any size property will qualify. But typically, cost segregation starts to make sense for properties that have a depreciable cost basis of $500,000 or more. Now, this value drops to the $300,000 range when considering cost segregation for a leasehold improvement project. The tax benefit compared to the cost of the study and the cost of your CPA's time may negate lower valued properties from being good candidates. However, with that said, we've done cost segregation studies on $200,000 commercial properties that have made good financial sense, and there is no upper limit. Of course, certain types of properties yield higher tax savings benefits than others. Properties that generate the greatest benefits include specialty use type buildings such as medical facilities, manufacturing facilities, and high-end office buildings. Now, warehouses and industrial properties tend to yield lower benefits, while residential garden apartments might fall somewhere in the middle. So how much should you expect to save with a cost segregation study? The savings derived will vary based on 3 different factors: the type of the property, for example, office, industrial, apartment complex, etc., the cost of the property, and the year it was placed in service. Now, almost every type of commercial real estate can benefit to some degree. It's not uncommon for a cost segregation study to generate tens of thousands or even hundreds of thousands of dollars in net present value savings. Now, the average study will allocate anywhere from 20 to 40% of the depreciable cost basis to a shorter tax life. Let's look at some examples of estimated savings you might expect to see. An office building with a $1 million value would save $46,926 in the first year with a cost segregation study. A self-storage facility, also with a $1 million structural value, would save $24,498 in the first year. And a small hotel, also valued at $1 million, would save $32,240 in the first year. 2 other important points. You can now go back to 1986 for any property and retroactively redefine your depreciation. And 2, all depreciation accumulated using the cost segregated method can now be applied to your tax return for the current year. A properly performed cost segregation study is unlikely to create additional exposure to a tax audit. The benefits of a cost segregation study are created by the acceleration of tax benefits, not taking a deduction for something to which you are not entitled. So if your property is held for its entire depreciable life, the IRS will actually receive all its tax dollars. However, the general feeling throughout the cost segregation industry is that the IRS has been getting a bit more aggressive about the review of cost segregation studies, specifically with respect to the methodologies being used and the qualifications of the preparer. As per the IRS Audit Techniques Guide, studies being performed by unqualified individuals and those using an abbreviated methodology will receive higher scrutiny than the ones performed by qualified professionals who utilize the detailed engineering approach. Therefore, it is more important than ever to have your studies performed by an expert in the field. You might be wondering, doesn't my accountant already do cost segregation for me? Well, probably not. Most CPAs or tax professionals simply do not have the expertise necessary to properly analyze all the factors that must be considered in a cost segregation study. And why should they? After all, they're CPAs, not engineers. With that said, some accounting firms do have trained engineers on staff to perform cost segregation studies, but the large majority do not. In the days before the IRS Audit Techniques Guide, some CPAs did make an effort to segregate costs on their own, but as the cost segregation industry has matured, most accounting firms are deferring to the specialty companies comprised of engineers and construction experts to prepare their clients' cost segregation studies. What's the impact of a cost segregation study if you sell your commercial property? Well, whether you've had a cost segregation study performed or not, when you sell a property, you will recognize either a gain or a loss. When you sell for a gain, you pay taxes on that gain. The amount of tax is based on the capital gains rate for real property and the taxpayer's ordinary income for personal property. When a cost segregation study is performed, items that would normally be considered real property are instead allocated to personal property. The ordinary income tax rate can be higher or lower than the capital gain rate, depending upon the situation. If higher, the amount of tax due upon a sale would likely be more if a cost segregation study were performed. However, the financial impact of the cost segregation study usually outweighs the effect of the ordinary income tax rate. Bottom line is that this is truly a facts and circumstances situation that will require analysis on the front end by your CPA or tax professional. We invite you to take a few minutes to check out our website. We have a number of article reprints that you can read from the IRS, accounting journals, and other financial publications. We've also included examples of tax savings for several different types of common commercial properties. And there's also a frequently asked questions section, plus a basic cost segregation estimator that will give you a very general idea of the potential tax savings from your type of commercial real estate. And finally, we'd like to invite you to request a free analysis of your property. You'll want to know if your commercial building qualifies for cost segregation. We'll prepare a no-cost review that summarizes the potential financial impact for your property. And after the review, if the numbers make sense, you can engage us to prepare a cost segregation study. Remember, it's your money. Thanks for watching.